Hi everyone, thanks for joining us today. Welcome to the first quarter forecast webinar for 2016 hosted by Yerba Buena Financial Partners, also known as YBFP. My name is Kay Robinson. I'm the Director of Client Services and Marketing here at YBFP. If you need any assistance to resolve any technical issues, please call Nicole at 415-334-8000, extension 105. Our guest speaker today is Michele Hassid. Michele is a member of our outside team of experts who will discuss tax law changes, tangible property regulations, and meal and entertainment deductions. Today's webinar will be hosted by YBFP partners Andy Zittell and Bruce Frankel. Topics will include where we've been in 2015, where we are today, and where we may be going this year, plus some important YBFP announcements. Out of respect for everyone's time, we plan to spend the next hour and 15 minutes with you and end the webinar by 1:15. Should you have any questions about the topics we covered today, please email them to info@ybfp.com and one of our advisors will give you a call to discuss the answer. We will be recording this presentation and posting it to our website for you to access following our time together under News and Resources/Events. It is our mission at Yerba Buena Financial Partners to guide and empower our select clientele to make informed decisions regarding their wealth so that they may make an even greater impact on the people and causes they care about deeply. So with that, let's get started, and I'd like to introduce Bruce Frankel.
Thanks, Kay. Thanks, everyone, for being here. We do these webinars quarterly, so obviously this one is the first of the year, so we'll be looking forward to a forecast, if you will. Just a couple, let me just step back a second, put things in perspective, which is the theme of the presentation today, is putting things in perspective. And this is an interesting little cartoon here, and it all depends on perspective, right? If you're stranded on an island, then you can't wait to see a boat or a ship of some sort. But if you're stranded on a boat, you can't wait to see land, right? So, but in stepping back a second, we are going to get into a lot of detail here, detail about the economy in the U.S. and around the world, some of the other situations that we see kind of out of the economic realm, but impact economies around the world. So we have tried to find a balance in these presentations to not get too technical. However, you are going to see a lot of numbers, a lot of charts. We'll walk you through them, and hopefully we have found that balance. So if you come across something that may glaze you over at the moment,
we may clear that one quickly.
Yeah, we'll get past it. Also, we end up talking a lot in here about investments and our investment models and what we're looking at and how we operate. Firstly, there's a lot of people on the call here who are new to us and may not be aware that when we do manage money, we are not buy and hold folks here. We are more tactical and believe that it's not just our job to help grow our clients' wealth, but it's just as important for us to protect our clients' wealth. And we'll get into more detail of that. Keeping with the perspective of things, we try not to look at just the day-to-day of what's going on, because that would create a situation that's out of proportion or perspective. So we don't necessarily just jump on that. Am I, Andy?
I think the only other thing to add for those people who are new to the call is that we're not just a money management shop, right? We are a comprehensive fee-based financial planning firm, and there are, we would encourage them to visit our website and learn more about us, and particularly the section called the 3 pillars, because there's a lot in constructing a portfolio or managing wealth for the benefit of a family and their ultimate heirs and the causes that they care about.
Yeah, that go beyond just investing in markets. Right. All right, so thank you for your patience there and getting through some of the logistics. So let's move forward. So where are we where have we been? But let's do the perspective, right? And you see the circles here, and as you're looking at the center circles, and you try to determine which circle is larger, right? Which one do you think is larger? Well, there's a theory called the Ebbinghaus illusion, and this is an example of that. And as you look at it, and we come to realize, well, they're actually the same size, those two circles in the center. And this is true as we go through and we look at many other things that we do in our work in helping people with their comprehensive planning. If we go to perspective of you walking by the street and seeing this mural on the sidewalk, it might be different than if you were actually the person sitting on the bench looking at that.
Right.
All right.
So to finish up on perspective, this is Andy, everybody. Good afternoon. This hiker looks like where did he go? There he is. This hiker looks like maybe he's just taking a rest and admiring the view around the lake when actually I have a technology issue here in Northern California. No, there we go. When actually he is taking a snooze. So I think the point of this is, as Bruce says, perspective is the theme. Few things are as simple as they usually appear. I mean, good news is bad news is good news. It depends upon the perspective, especially when we talk about the economies and economics in an ever-growing, interdependent global economy. One of my favorite old quotes from a song is, one man's floor is another man's ceiling. So it's all about perspective. So let's start by taking a look at where we've been. Whoops. And on a broad view, there we go. On a broad view here, what we have in terms of 2015, and this is one of those slides that has some just raw data for you. Last year, the S&P 500 was basically flat. Year to date, it's down 5.5%. The 10-year Treasury bond ended last year's yield with 2.27% and is currently at 1.7%. That's a pretty significant change in terms of percentage. The World Index, which is the index that we would say most closely resembles our equity models in general, which we'll talk more about later, was down 2.7% last year and is flat year to date. Emerging markets, they were hammered last year. They were down almost 17%, and they're down 7% right now. Gold was down 11% last year and is currently up 15% for the year. It's a pretty amazing turnaround. No surprise there, though, given some of the fears around the markets and the economies. Commodities last year were down 24% and are flat right now. Now, the interesting thing is about these stocks in the S&P 500 is that the average stock was actually down 11% from its 52-week high, and the few individual stocks that really drove stability or growth in the S&P 500 is what a new acronym we're going to share with you today, FANG. Those stocks representing Facebook, Amazon, Netflix, and Google.
Now called Alphabet.
Right, what's that?
Now called Alphabet.
Now called Alphabet. So one could surmise by looking at this particular slide that 2015 was a volatile year, especially in the second half of the year where you see that big dip at the end of the summer. As we know, volatility can be difficult to tolerate, but we have to keep it in perspective. I mean, remember 2008? That was a pretty painful year, right, Bruce, in terms of volatility?
Yeah.
And if we look at it in context, let me hit that, there we go. 2009, 2015 was much smoother, and here it is relative to the size of the S&P 500 in general. So when we talk about the S&P 500, let's remember that the S&P 500 is an index. So this is one of those slides that might be a little bit confusing here and there, so I'm going to do my best to
But we put it here on purpose.
Yeah, definitely. This is really an important slide because the S&P 500, which as you know represents 500 companies in the United States, the largest 500 companies, is really made up of different sectors. And as you can see here, some sectors fared better than others last year to make up the overall performance. Now, we're going to talk a little bit more about it later, as Bruce alluded to, in our portfolios and our active equity management. We pay very much attention to different sectors. But in 2015, the sectors that did better than others were consumer discretionary and healthcare, which you can see there, and the ones that didn't fare so well, which I think we hear about in the news all the time, are energy, utilities, and materials.
So just to reiterate, so as we're developing our models, right, everything that we just covered up to this point is incorporated in our models, right? The good, the bad, the ugly. It doesn't necessarily mean that we are open or exposed to any of them at any particular time, but our models do make up all of these sectors and more, as well as domestic, international, emerging market, commodities, including gold, and of course fixed income.
Right.
So just as a reminder.
Great, thank you. So I think uncertainty played a very large role in the stock and bond markets last year. Fiscal and monetary policy in particular. I mean, is the Fed going to raise rates? When are they going to raise rates? How much are they going to raise rates? They should have raised them already. They didn't raise them. Back and forth. Nobody really knew, and it just kept people kind of on edge. I mean, in addition to that, we had just some normal events that happened. We had a very cold winter here in Northern California. We had ports closed because of dock strikes. Earnings didn't, things looked better, then earnings didn't look so good by the end of the summer. There was uncertainty again about the Fed. So uncertainty always plays a role.
And when the summer hit, right, that's when we started to see particular volatility. And when the real interesting market dynamic of good news is bad news and bad news is good news hit, right? The good news being bad news meant that interest rates were most likely going to go up, which will slow down the economy. And the bad news of any economic data that came out that wasn't positive started to send messages to market participants that the Federal Reserve might not raise interest rates. So this good news, bad news, good news thing is one of the silly elements of our markets, but that's
reminds me of the teacup ride in Disneyland, where you just keep getting spun around.
Yeah.
But let's bring Europe into the picture. Europe was also volatile in 2015, and if you look at that gray-blue line there, it represents the DJ Stocks 50 index, which is really an index of the Dow Jones, 18 companies on the Dow Jones, and the 50 largest companies in Europe based on market capitalization. And when you look at this, the S&P looked a lot less volatile than did Europe. What else is going on in Europe? Interest rates are falling. They're falling below zero. I mean, when I went to school and studied economics, I wasn't taught that interest rates could go negative or that there was a number below zero. And what we're finding now is that's no longer the case, and that it can happen. And the results of some of this, I mean, in its simplest form is well, an example, in Denmark, for example, a homeowner is paying principal minus interest on their mortgage each month. Bruce and I were talking earlier about this, and the discussion was, right, about the disincentive to save and the incentive to borrow.
Well, I mean, if you just stop and think about it for a second, right, you can put money in the bank in Europe, Japan now as well, and you would end up paying the bank a storage fee to keep your money there, right? They'd be charging you to keep your money there. And if we just take, I think we have the time for now, if we just step back a second and sort of, well, why would they do that, right? What are they hoping to accomplish by doing that? I think the next slide also portrays, Andy, just how
many
pervasive,
short,
how pervasive this is throughout Europe, right? Japan's not up there yet. It's Japan started that strategy after this slide was made.
Right. I mean, the intent, before you finish that thought, the intention there, obviously, by them lowering these rates and going negative is to encourage spending, right? Encourage spending, try and get inflation higher and stabilize the currency. But
Well, yeah, so, which goes against everything that anyone hears out of our office or any financial planner around the world worth their weight in salt, right? Because we want people saving money, right? We don't expect people to live like a hermit and eat rice and beans, but we want people to be saving for their future and the future of their children and whatever legacy that they want to leave. And here we have the central bankers around the world encouraging the opposite, right? Encouraging more debt, encouraging you to spend and spend and spend. And it's understandable why, because the more consumerism that there is going on in the economies, which is 70% of the economy, is going to help the economy grow. It's a short-term tactic towards a strategy to grow an economy and can hurt a lot of people. And
it is not sustainable.
It is not sustainable, especially the debt level.
Right. How does the bank continue to lend money when they can't take in deposits?
Right.
It's just not going to work. So adding another perspective, let's bring the emerging markets into this same set of slides that we're looking at. And when we look at the emerging markets, which is represented by that yellow or orange line, it makes Europe and the United States look really mild and easy. No surprise, because emerging markets are historically a more volatile and bumpier ride. Now again, as we talked about before, in the creation of our models, we are using all of these different indices and sectors. So what's going on with the slower growth in these countries? I mean, according to the ECB bulletin, trade growth has slowed, commodity prices have collapsed, and financial conditions are difficult, which is why the pace of growth in emerging markets is grinding to a halt.
The only bright spot is India, really, that hasn't ground to a halt.
I wonder if it has to do with that policy. Did you read the article about IKEA the other day?
No.
So IKEA wants to open stores. They're talking about the growth of IKEA.
Yeah.
They want to open stores in India, but India has a policy that says a certain percentage of the merchandise must be manufactured locally.
Uh-huh.
And IKEA was having tremendous difficulty finding it because the plates were leaching certain chemicals, the other things were doing. But India at least is trying to maintain production. Mm-hmm. It was pretty good. So as a result of this, what's happening and why the prices emerging markets continue to be bumpy is there's a net outflow of capital.
Yes.
That's just pretty.
And I'd like to take a second here. So this issue of capital flight, as they're calling it now, is happening. The trend of that is growing and growing. In the last several months in China, it's getting to be very concerning for the government. They've tried to put some restrictions on it and whatnot. For example, you can't take more than $50,000 out of the country at any one time in cash. So what are they doing? They're getting every relative they can to take a trip to Hong Kong and stuff their pockets with money to get as much money out of the country as they can. We're seeing companies being bought, land, real estate, the creativity that is going on with wealth, the new wealth in China and throughout the emerging markets, but particularly China, is quite dramatic. Now, we'll touch on this a couple of times, but there's actually a People's Congress that's going to be happening in the first week of March in China, and we're expecting for China to come out with some rather dramatic actions to try and curb capital outflow as well as prop up their stock markets and their economy.
So I think speaking about the outflow in China is a great segue to another slide here, where now we're adding China to this particular graph. So we add China to the graph, and now emerging markets even look placid.
Right.
So in China, so here, for example, you could see that during the course of 2015, I mean, the Shanghai Composite went up almost 60% at one point, and then plummeted. I mean, ended up the year up 9%, but more and more volatility. And things aren't always what they seem to be in China. I would encourage everyone to take a moment and just read this slide. So this quote in China and the things Bruce was talking about always remind me of Charles Dickens' A Tale of Two Cities, right? It was the best of times, it was the worst of times. So we've never been able to, well, in China, as we know, currently, there's not the same regulatory controls that we have here in the West. So we've been not sure if the data that we get is correct. You know, is the information honest? Is it being scrutinized properly? And even though it's getting better, we think, the evolution is slower than we might like to be able to effectively and with confidence participate in those markets. I mean, we made a conscious decision a couple of years ago to stay away from individual securities that were coming out of China because of that information. So it's frustrating in that way because we really don't know what's true, but at the same time, the possibilities are limitless with 1 billion+ people who are going to have a need and a demand for products and services as this generation
Well,
goes
and if
on.
they're hoping to grow a middle class and bring more people out of the rural and locations into the cities, and that's why they built all the faux cities, and anyone who's been on a previous webinar of ours has seen our illustration of
those ghost cities,
the ghost, you know, cities and highways and subways that they built. Even now, however, I mean, some data that came out a few weeks ago just immediately is discarded as not believable. And that's where we have to go to some other elements that help us understand what's really going on in the economy for us to understand. We'll talk about some of those later in the webinar. I mean, one of them is just looking at electricity rates.
Right.
Electricity usage.
We're monitoring that.
Yeah.
Yes.
But okay, great.
Why don't you take over the next section there, Bruce?
Well, thank you, Andy, and that was great. Now, talking about where we are now, it's impossible for us to just completely ignore the election. The election does have a great impact on the economy, not just for who might and might not get elected, and as the market participants try and guess and gauge what the reaction is going to be from that, but do you know the amount of money that these folks spend on these campaigns? I mean,
more than Super Bowl rates.
The amount of money that floods into these states, I guess in New Hampshire, it was wall-to-wall commercials on TV, right? So none of us would like that at all, but you know, the amount of money that gets
amazing
flooded
how many
into
other
those
problems
economies
we could solve with that money.
Well, it's just interesting. It's almost like part of the election cycle. The economy is dependent on the election cycle to a degree. But when we look at this, we did some work in looking up, Seeking Alpha is a great research company, and they went out over the last 87 years and tried to look at, okay, in the first, second, third, fourth year of a presidential term, what is the volatility in the returns net on the stock market? In this case, the S&P 500. And you can see it was pretty negligible. So their determination was it really has very little, if any, impact. Now, you can see volatility by the black line up and down is a different item, especially in the first and second years. But the net of any growth or not is pretty negligible.
That makes sense as a new administration works with the...
Well, during the election, well, in the fourth year? Oh,
first 2 years?
Yeah. All right, so now going ahead and looking more at the overall, what's going on in the overall economies, and this is the relative health of the economies, and this was put out by The Economist. And you can see the biggest concerns now are what's going on in Russia and Brazil, amongst the biggest concerns out of these economies anyway.
Disclosure, Brazil.
Well, for me, right, anyone knows me, my wife Claudia is Brazilian and has a huge family in Brazil. My wife has 60 first cousins in Brazil, and they're struggling. Inflation is very high. If you're on a pension or fixed income, you're hurting. A lot of people out of work. Now, this is an economy that was flying, flourishing, was the gem of the world of look what's going on in this developing country over there. It's changed dramatically, and for the same reason that it has in Russia, they are very dependent on oil. So any of these countries that have such a reliance on oil are feeling this very, very hard.
Mm-hmm.
When oil goes from 106 to 40 in 2015, and now it's all the way down to 30.
It was 31 and change today.
So that represents a 72% decrease in the asset that these countries are not just invested in, but completely reliant for their economies to flourish.
Yeah, so let's take a little look at the history of oil. The last time that oil cost less than $1 a gallon was when Jimi Hendrix sang the Star Spangled Banner at Woodstock. The Miracle Mets, sorry Bruce, won the World Series. And in 1969, the cost of a Super Bowl ad was $55,000. Oil was just over $3 a barrel. He doesn't like that. There we go. That's cute.
So let me tell you.
He still hasn't gotten over it. You know.
Let me tell you.
You need to get over it.
Okay, so I'm a Chicago boy, and in 1969, my Cubs were heading to the playoffs, and Andy's Mets came back from 10 games down in the month of September to beat my Cubs. So that's just a little internal.
And I digress for another second. It was a highlight of my life in that I was at that World Series.
Oh, were you?
And I actually have a ball pitched by Tom Seaver, hit by Brooks Robinson, and caught by my beloved father,
You
Paul
never
Seaver.
told me that.
Yeah.
Really?
Yeah.
You've never told
I
me
have
that.
it on.
Good partners.
Have it on display. My nephews tried to
13
steal
years,
it.
You never told me.
Yeah. So, when was the next time that oil went above $1 a gallon and never went below $1 a gallon again? It was in 1990. Now, it had gone above and back and forth in 1981, but in 1990 it went over $1 a gallon and it stayed there.
Look
since.
what's happening to Super Bowl ads.
Yeah,
right?
look at the cost of the Super Bowl ad. $700,000. Oil was then $15 a barrel. And then again, as you can see, the prices are getting high again. So in 2008, it was 100. This kind of reminds me of last year in terms of the numbers.
Right.
And
but $144 a barrel.
Right. And the cost of a 30-second Super Bowl ad is $2.7 million. I think one of the things, it's interesting about oil, because we were having a conversation the other day, we were talking about the impact of this. And so I did a little bit of research for us.
Okay.
Well, so according to the U.S. Census Bureau, there's approximately, I'm just going to round the numbers out to keep it simple, but there's approximately 125 million households in America, and 80% of those households own vehicles.
So what does that equal?
The average household, 100 million households with vehicles.
Okay.
The average household drives 20,000 miles a year at an average, according to the Department of Transportation, of 20 miles per gallon. Keeps the math simple, which means that a household is using 1,000 gallons of gasoline a year. Okay? Let's just say that because of this decline in price in oil, that we're saving $1 a gallon from what it was a year ago.
Okay. Not here in California, but okay.
No, it was $3.50. It was almost $4. It's $2.90 today, right? So around $1 here or there. So $1,000 times 100 million households is $100 billion.
Okay.
In less money that's going directly to the pump.
Right.
Now, we can't make the assumption that all of that money is going back into the economy. Some people are paying off debt. Some people might be saving it. So the velocity of money conversation can't really be had in terms of the real impact. But how does it relate to the good news, bad news? Good news, it cost me less at the pump. Bad news, people who are working in the oil industry because of this are losing their jobs, right? So if you take an earner as an average number in that industry of $60,000 a year, you need 2.4 million jobs is going to equal that $100 billion.
Right.
And as you like to remind me, $100 billion, it's a spit in the ocean compared to our economy.
And we can't expect 100% of that money to be put back into the economy. That's just not realistic. Unfortunately, many of the talking heads on TV and economists in the country were talking about that we'll have growth in GDP in the country because of this. And it never came to be. And that Christmas spending was going to be that much more because people were saving on it. And the weather was warm, so they weren't spending as much money on oil. And unfortunately, that just never came to fruition.
Right. And I mean, even the other backlash that I experienced, so I just put a solar system on my home, as you know. Right?
Yeah.
Interesting. So I put a solar system on my home, and I designed it so that it would produce all the electricity I need. So I would not have to really buy any electricity from the utility. Well, I guess a few other people have decided to do this. And so PG&E recently sent me a notice saying that everyone who has a solar system is going to have an additional surcharge on their bill. And we're going to raise the rates to make up for our lack of profit. It's like buying the airline ticket. Right?
Well,
right. If fuel prices are going down, it should cost me less to fly to New York.
So for everyone on the call that drives an SUV is happy, but Andy's not doing so well. Back to perspective. All right, back to our presentation. It's important that we talk about what's going on with the central banks around the world. As we all know, here in the U.S., the Federal Reserve has been telegraphing for quite a long time that they're going to start raising interest rates at some point. We here are of the belief that central bankers tend to always wait too long and go too far, and the pendulum will swing to its peak on either side. So now this Federal Reserve of the United States has started to raise interest rates. They're kind of caught in a quagmire now because they didn't do it when the economy was, doing better than it is today. So what are they going to do going forward? At this point, they don't have their powder dry very well. So we'll see what happens. They have backed off of talking about 4 interest rate increases in 2016. Now the bet, and when I say bet, I mean literal bet, you can get odds in Las Vegas on this, and those odds have been changing dramatically in the last month. So that now the odds are in favor of a 2 or 3 interest rate of increases.
And you get paid off in Bitcoin, right?
So that's what's going on with but we have divergence here because the central bank in Europe is heading full steam down the highway of quantitative easing, including negative interest rates, as we already talked about, and trying to flood the economy with money. So they're literally printing euros, buying up securities in order to get more and more of this money into the economy with the hope and prayer that it gets used. The other central bank not mentioned here, however, is Japan, who has deployed Abenomics, which is quantitative easing on steroids.
Right.
In printing a lot of yen, buying a lot of securities, doing everything they can to prop up the stock market, their economy, and everything to try and get out of what has been a 25-year stagnating economy with deflation, which deflation, folks, is more insidious than inflation. And this is the situation that, we find ourselves in with these central banks around the world.
So we have this quagmire here, right? Again, where we have a global economy and nation states are making their own decisions, but we're interdependent upon each other, trade, currency, export.
Yeah.
And it's foolish to think that what the European Central Bank isn't going to affect what we're doing here, or what we're doing here isn't going to affect Japan.
Exactly.
And everybody just does what they do.
Yeah. So Mohamed El-Arian, formerly of PIMCO, and now with Allianz, put forth this statement that the short-term implications for investors include a stronger dollar greater equity market volatility, and a wider trading range for key interest rate differentials. The longer-term consequences are up for grabs. So we just don't know what is going to happen in the end. A lot of what the central bankers are doing is purely experimental. It's never been done before. They don't really even know how they'll get out of it. So we have to look at more volatility.
And again, coming back to our theme of perspective, the good news and the bad news, based on that slide, I just want to go back to that for a second there, is that, so Bruce, you and Claudia want to take a trip to Europe, take a vacation.
Right.
Your dollar is strong. You're going to get more bang for your buck when you go. That's good news. So let's just imagine for a second that you were a manufacturer of widgets and you were looking to export those widgets to Europe. Your business would be hurting.
Yeah. And it's globalization one, as you say. I mean, this is happening everywhere. So as the dollar gets stronger, it really hurts people, manufacturers here, and the companies trying to export here, but it's hurting other countries and companies that trade in, do business in dollars. It's not just here in the U.S. And then as interest rates go up, these emerging markets get hit very, very hard. All right, so now we get into some of the talking heads, as we call them, and what they're saying about what's going to happen. Now, again, for those of you who are new to us here, we do not believe in prognosticating because, as we just said, we are believers that in the end, because of all of the complicated dynamics that go on in the economy, in the world economy, that we really just don't know what's going to happen. And anyone who says they do is at risk. Here's a gentleman, Chief Investment Officer at Federated, a highly respected, highly educated gentleman who thinks that we are in a time of the markets being able to rise. So he says here, long government bond yields stuck below 3% and likely to remain there for some time, that investors gradually come to the realization that equities with their growing cash flow streams are back on solid business prospect, are worth far more than they are at current levels.
So
but then we go to the next fellow, Henry Blodgett, who I follow quite a bit, and Mr. Blodgett says that stocks are now more expensive than they've been at any time in the past 130 years. 130 years. Now, the truth is probably somewhere in the middle because we just don't know. Here is showing us what is going on with actual valuations. So let me walk you through this real quick, this chart. So the blue line is a price earnings ratio, right? PE ratios. And it's something that we watch quite a bit because as you see, when they hit their peaks and valleys, they do tend to turn around. And the red line is long-term interest rates. And so you can see when one goes up, the other goes down. And then some of the quite dramatic turns. Well, right now, if we look at the blue line, price earnings ratios are at, let's call it 26. Not at historic highs. Those historic highs go back to 1929 and 2000. So I don't think we want PE ratios to get to that.
No, they're well above the average.
But they're well above the average of 16.
I mean, just look at 2000. You can interpolate in there 2008. Those dips.
Yeah, I mean, just follow that, and you can think about what was going on in the world at those, at those times. 1981, right, was the end of the Carter administration, and interest rates were, 15%, right? Mortgages were very, very high.
But you get 13% in your money market. So again, good news, bad news.
Yeah, and then we have this lady that says that their work suggests valuation is a poor short-term timing indicator. The single most important determinant are long-term returns. And we agree with this. And this is why we do manage money the way that we do. All right, if before I get into that next slide here, we're going to talk about our models now. And we want to inform everyone on the call of what we've been doing with our models over 2015 and up to today. And so this chart here illustrates that. And this is a model that is one of our more popular models with our clients, and it is our sector strategy for equities, and you see that represented in the blue, and our taxable fixed income model. Thank you, Andy. That you see represented in red, and the green is cash. This is a moderate model, and we talk about the risk tolerance or how aggressive the model is.
That would allow for maximum exposures of 60% to the equity side and 40% to the fixed income, and that's the strategic allocation part of it. But now you're going to talk to the tactical application.
And so what we've been doing is, you can see going back to December 2014, where we were pretty fully invested on the equity side, but not on the fixed income side. That's zero. And that was a time when the prospects for interest rates going up were quite high. Most of the indicators in the economy were pretty strong. And so that was a time for us to be more careful in the fixed income market. As you can see, we increased our exposure in fixed income in the first quarter of 2015. So each of these bars is representing a quarter, or where we were at the end of that quarter, I should say. Mm-hmm. And then we decreased our exposure in the June quarter, the second quarter, and we start to decrease over time here quite dramatically. And now, and as of the middle of that second quarter, we started to get into what we call here protect mode, where the risk-reward dynamic in the markets is just not promising. It's just not something meaningful that we should be putting our clients' hard-earned, hard-saved wealth at risk. And rather than enter into all that volatility and risk, we choose to wait for some of that to go by. Now, we will start to deploy some of this cash, because we don't want just cash there too long. And we will be starting to deploy some of this cash, but they'll be deployed into some of the more defensive positions that we follow, rather than just simply entering back into risk just for the sake of being invested.
Yeah, and if we remember from the earlier slide, we're at the very beginning where we talked about the volatility of certainly the S&P 500 in the U.S. markets, how it took that big dip in the summer. And you could see it here. I mean, in this instance, in this particular case, we were on the right side of it. We just got out of it and let the volatility go on without us.
Here's where we are invested today, and this is portrayed. The two blue boxes there in the middle are the very defensive positions that we're in utilities and gold, and we believe cash is a protection asset and tool that we use.
Just quickly, that slide just talks about the 23 sectors that we talked about earlier in terms of our sector strategy, where we try to participate when we're evaluating the sectors that made up the S&P 500.
All right, let's take a breath. That was a lot. So, Kay, could you please, we wanted to talk about some great announcements and interesting things that we have happening here. Would you mind, please?
Yeah, so we're really excited about a couple of things going on here. We have a very powerful strategic alliance that we formed with YBFP and Michelle's CPA firm, Eckhoff and Company. And you'll hear more from Michele later in our presentation, and we're really excited that she's here with us today. The alliance will give clients the value of both firms working together to bring a truly comprehensive tax and financial advisory experience. And this is without any obligation. Clients will be offered a complimentary second opinion service in order to complete a comprehensive review of the client's current situation. We've also created a new client phone number, and this is to help us prioritize our calls from clients. And we plan to send this out within the week. And I also wanted to say that if you are an existing client and haven't seen Andy or Bruce in the past 12 months, please give us a call to schedule a meeting. And lastly, as most of you know, we distribute a weekly market commentary, and it has, all the up-to-date market information that we send out weekly. Please go ahead and sign up for that online or send us an email at info@ybfp.com if you would like to receive that every week.
And that's like a 5-minute quick read on Monday mornings for people.
Yeah, and it's really informative.
Written in non-financial speak.
Yes. So
right. Yeah. So if you'd like to be on for any of we have a weekly market commentary, we have a monthly newsletter, regular articles, and Bruce's blog. So if you're interested in any of those pieces, again, just email us at info@ybfp.com and we'll get you on the list. Okay, and now I'll turn the presentation back over to Bruce.
Thanks, Kay. Thank you. I am really excited about what we're doing together, Michelle. I mean, we've already seen that we're going to be able to help people and doing things differently in a collaborative fashion, so people don't have to be running around from professional advisor to professional advisor. So that's just great. And
it's been an exponential impact.
Michelle's in the middle of tax season right now, so thanks for being here. That private client phone number we're also excited about. We get a lot of phone calls around here, and we want to make sure we can prioritize our clients.
And so now there's no excuse for not calling in and scheduling an annual review.
All right, let's move on to where we're going. So if you look at this cartoon, right, it's about perspective again. Technology has changed a little bit. These folks were worried that hieroglyphics might be outdated, but were they right or wrong? I'm not so sure. All right, so what are the prognosticators saying, right? So this, according to the conference board, who puts out their thoughts about growth rates around the world. If you could go and read some of my blogs, you'll see where I point out that even though they are supposed to have all the data in order to make really good informed decisions and give us good guidance, that they don't seem to be very accurate, and even along the way tend to change their outlook as we go along, and they find out that they were wrong. But as you scan down here and you look at it, it doesn't look like an impressive year for turnaround and growth, right? Japan may be the most with the biggest variance year over year, and they put Latin America in there in general, which I don't think is a good thing to do. But we're not looking at any very impressive growth, and especially when we look at some of the countries where we've really had it. So we're watching that. We're watching this dynamic as it plays out, and we've talked about it so many times, of that now the developing countries represent 50% of the world economy.
Right.
And it's not anything that could be ignored anymore, right? It used to be that if something happened in some of these countries, it wasn't a big deal to our economy. Well, that's no longer the case.
I mean, the speed. Just a quick thing on there is that the speed with which an economy and a nation can industrialize and go from emerging to developed has
well, they're bypassing technologies, right. Literally leapfrogging in technology.
So, and those countries are changing regularly, so that has an effect on that.
One of the things that we watch here is going to, it's going to be a little esoteric to a lot of people, but something called the Baltic Dry Shipping Index. So first of all, what is it? It is the pricing of the shipping overseas, all over the world, of dry goods. Steel, parts, plastics, rubber, wire, all of these things are it's not oil, basically. So oil is taken out because of the volatility in general that goes on in the oil and shipping of oil, and how much it's affected by supply. So why do we watch this? And if you go back and you look historically, when the pricing of shipping dry goods goes down, it's not it's a good leading economic indicator for us to be looking at what's to come. Most of the things that are shipped this way are feeder products into manufacturing, raw materials. And if the shipping of raw materials is going down so dramatically, that means that there's too much capacity and not enough demand, pure supply demand. That's not a good indicator for the economy, what we're seeing here. Now, we've seen a bit of a tick up in the last few months. Hopefully that trend continues, and we can see that happening. The other indicator that we watch here quite a bit is this participation rate, the labor participation rate. We're not big believers here in focusing on the employment or unemployment number that comes out of the Labor Department. Well, why? There are too much noise in that number. There's too many other dynamics that impact that number that can make it misleading. Over a number of administrations, they've actually changed the way that they calculate the number. And of course, when administrations are changing the way numbers are calculated, they're going to make it so the number looks better. So how do we clear out all that noise? And what we do is we like to look at the labor participation rate, which is telling us, of the people in the labor force, how many, in this case, what percentage have a job that they are ready, willing, and able to have. And if you go back across here, we have been hovering down at 40-year lows in this number. Now, there's been a recent uptick. We've seen a little bit of an uptick, so we're watching these uptick indicators right now, and we want to be encouraged by that. The long-term trend is not good. If the uptick continues, then let's just follow the tea leaves, if you will, right? If participation rates go up, that means employers will have to compete more to get people to hire people. Demand for employment and employees, if we would look at employees as a raw material, right? The demand for the employees, forgive the gaucheness of that, the demand for employees will go up. Again, it's pure supply demand. So that means the pricing for employees will go up, wages. Right. When wages go up, people are feeling good about the economy.
And they're spending.
And they're spending. Now we get this concept of the velocity of money, money that keeps turning over in the economy and turning over in the economy. Then we start to get really nice, fundamentally based growth. And if we see trends in that, that starts to feed on itself. Those are leading economic indicators that we
And if we follow that just one more step, then there would be healthy inflation for that reason.
Right.
Which would mean that the interest rates would be raised for the right reasons as opposed to artificial injection.
Still, we have to watch what's going on in the emerging economies. The trends we are seeing there, excuse me, I'm sorry to say, are just simply not good. Quantitative easing has not proven to be anything that is sustainable on the long term, and then they do not know how they're getting out of it. The debt and the amount of debt that emerging countries and their population and their businesses are incurring are at record highs. And when those debt ratios become so high that they can't be serviced because of the economy not growing enough, or even worse, if interest rates start going up and the interest payments are not sustainable for them to keep making their payments, then we'll start to see defaults, and then that's a negative spiral. What the Federal Reserve does here, we do think they probably will raise rates a couple more times in 2016. Many of the regional Federal Reserve Bank officials have come out to say that they do not see major signs of a recession in the United States, which means they're They tend to ignore what's going on in the international markets. If they do raise interest rates a couple more times, I don't think it'll be catastrophic, but it will impact the perception of market participants, and it will affect what's going on in international markets. And then, is this differing central bank policy a problem or an opportunity?
As we were talking about earlier.
Right, so when Mr. El-Arian is here again, and as he talks about in this excerpt from a comment that he was making, it sometimes causes there to be price separations and things that we can take advantage of. And then when those trends turn around, being that we are in protect mode, we are going to be in an excellent situation to take advantage of those opportunities. Whereas if we were fully invested, we would not. We simply can't ignore terrorism. It's a dynamic in our society now that we just can't ignore. The amount of money that has to be spent around the world is just increasing dramatically. The number of deaths that are occurring around the world from terrorism, if you look just over the past 5 years on this chart, has increased dramatically. Don't want to be, any scare tactics here or anything, but for us here, so you know what we're watching, this is definitely among the dynamics that we are watching. Here we have what's going on in global trade, the volume of trade versus the value. This goes back to the Baltic Dry Index. If you've never heard of Baltic Dry Index, you can talk about it at the dinner table tonight now with your family. But what we've seen here happening now is a decrease in volume, which has tapered off, but is going down, is trending down again in the last several months. And then the value of that global trade has gone down dramatically. So Andy, where are the markets headed?
This is my favorite slide, and the reason why it's here is because they didn't invite me to that board table, or it wouldn't be unanimous. So the strategists, again, everyone is expecting that the S&P 500 is going to increase in 2016, that GDP growth is going to be 2.5%, earnings growth is going to be good, P ratios may contract, but again, prognostication. We don't really know what's going to happen there. A couple of others will say in terms of, oh, this is a fun one for us. Good. So I'm going to read this to you, folks. An oil prospector moving to his heavenly reward was met by St. Peter with bad news. You're qualified for residence, said St. Peter. But as you can see, the compound reserved for oilmen is packed. There's no way to squeeze you in. After thinking a moment, the prospector asked if he might just say 4 words to the present occupants. That seemed harmless to St. Peter, so the prospector cupped his hands and yelled, "Oil discovered in hell!" Immediately, the gate to the compound opened and all of the oilmen marched out to head for the nether regions. Impressed, St. Peter invited the prospector to move in and make himself comfortable. The prospector paused. "No," he said, "I think I'll go along with the rest of the boys. There might be some truth to that rumor after all."
And being a contrarian is not necessarily a bad thing. It certainly gave that guy more room to live. And we have just a disparity now of what we're hearing, where, someone talks about 10-year Treasury bond yield staying at 1.5% in 2016. Again, a bright person, highly educated person, but equally educated and bright person says that Treasury yields are going to go up to 2.6 to 2.8%, and today they're at
1.7.
Yeah.
And if they stay at 1.5, as one of these predictions is, it means that our economy is not doing very well.
Right. And if it goes up here, it's a sign our economy is doing pretty well, or they're worried about inflation, but that's not going to help people overseas.
Right. Global interdependence.
Well, what we will be doing is trying to enjoy ourselves and watching all of these things for you. We're the ones who are supposed to be the worry ward, so you folks can go about your daily lives and not worry about these things, and let us stay up at night thinking about them. But now we want to turn things and have a little conversation with Michele, who's been sitting here unbelievably patiently while we've gone through all of that. Riveted. Absolutely riveted. And so now for some really exciting topics for people, we'll get into tax. Let's talk about that.
Tax tidbit hour.
All right. Michele, we've been talking, quite a bit about, first of all, how we work together and help people with tax and all the work that you guys do over at Eckhoff, which is just great because you have a whole team over there. It's like a mastermind team of 25 people.
Great team.
So that when you're presented with situations that might be out of the ordinary, you guys can,
collaborate.
Exactly.
Yes.
And so I like to ask you questions, all CPAs some questions. What's some of the funniest things, before we get into some of the other, drier things? Do you have any funnies to tell?
Story?
Yeah.
Well, every year, Kiplinger puts out 12 to 15 tax deductions that you won't believe are real. And so one of my favorites this year was the story about free beer, where
do I go?
Your nearest gas station, apparently. This person who had a service station, in this novel promotion idea, offered his customers free beer with a fill-up. So obviously, gas station the sales went up significantly. So proving that alcohol and gasoline do mix, at least for tax purposes, because it was challenged by the IRS, but the tax court allowed the owner to deduct the cost of the beer as a business expense.
Wow.
Have one for the road.
Right? Marketing.
And we talked about the pets that are brought into the office. I bring Milo into the office. And if they're in marketing materials and, you talked about the cat in the junkyard.
Yeah, cat in the junkyard. So there was the business purpose, the cat in the junkyard, and catching the rats or mice or snakes, cleaning up. So that was a deductible expense, the food and maintaining.
And the vet bills.
The vet bills and all that. So being creative isn't necessarily a bad thing. There's no reason to pay the IRS more than you actually owe, but
right.
The lesson always is that documentation is king.
There we go. And then now in 2016 tax season, whoever created that phrase is an interesting thing, but for the 2015 tax year, so you're in the meat of it right now.
We're in the meat of it.
So
yeah.
What are the hot issues that the IRS is having on 2015 returns?
Well, the Affordable Care Act and some provisions related to that, namely the premium tax credit, this individual share responsibility provision, where if you're not covered, there's penalties, and the net investment income tax and tangible property regulations. So
let's talk more about the ACA.
The ACA.
Yeah. So are people just utterly confused about what they have to do?
There is some confusion. And it depends, where you are in your income level. There seems to be people that are happy with it and finally getting covered, but there's other people that are kind of left without. It's too expensive to get coverage, and they're not getting the proper coverage with the ACA rules the way they are. People that are between 100% and 400% of the federal poverty line can get this premium tax credit in advance. The problem comes at the end of the year when maybe they've made more money or they're over that 400% and they're taken by surprise that they have to give that money back. So there's issues with that. There are issues also, there's a question on the tax return now that everybody preparing their own tax return or tax preparers have to ask is everybody in your household covered, insured for every month of the year? And if you're not, the maximum penalty for each month per person is $207 for 2015.
Per month?
Per month, per person, if you weren't covered.
I had no idea.
Yes.
Okay. So are you having people getting, what about, the higher income folks, right, that may not choose or self-insured?
As long as you have to have proof of coverage. and you should be getting that from either Medicare or your health insurance company. The IRS, I believe, extended the deadline for health insurance companies to give that documentation, what's going to be a Form 1095, A, B, or C, till the end of March.
Oh my goodness. So you have delays. There's been
delays.
There's been
More
delays
delays.
from the investment companies providing 1099s, and a lot of it is either complex product or international product that's causing that. Now you have delays in reporting for the ACA Act, so tax quote season is getting contracted even more on you guys.
It is. And as far as the ACA goes, you know, some tax preparers feel like we're almost the police for the IRS,
Right,
right,
and
trying to get this
that.
information.
Right.
Yeah.
So tangible property regulations, so this is a change, and it's complicated. We don't want to get too far in the weeds, but it is something that you wanted to make a point to people about. So first of all, what is tangible property regulations?
So the tangible property regulations is an issue the IRS has deliberated on for the past 10 years, and they really affect every business owner and every property owner. So it's all encompassing, it's complex, and the implementation actually requires a detailed look at the taxpayer's facts and circumstances and what they're doing. So it relates to improvements, materials, supplies, any cost of acquisition for any tangible property.
What's a couple examples of tangible property?
Tangible property, equipment, a building.
Okay. Anything used in the business? Anything
used in the business and anybody that owns property for just an investment purpose.
Okay.
So it allows for some tax planning, but because it really turns all the rules upside down from where they were historically, what taxpayers and tax preparers historically thought of as costs that would be typically capitalized may not be at this point anymore with these new rules. So it creates a lot of compliance risk on both sides that things are done correctly.
Okay.
So it's important if you own property or have a business where you're purchasing property or equipment, you have a lot of supplies now, and things that you keep in your supply closet, pencils and paper, or, anything like that, potentially could be capitalized.
Oh my goodness.
When it was historically written off.
Just an expense.
So the rules are turned upside down from what you know. My best
Am I going to have
advice
to
I can give
depreciate
you
pencils or?
right? Possibly.
With the erasers.
Is to, seek advice.
Yeah, well.
It's comprehensive.
Yeah, and then, now we work with individuals and families, of course, but we will specialize in working with entrepreneurs. Now, entrepreneurs are, I'm going to use the word infamous, about what they do in taking deductions for meals and entertainment. This has been going on forever, and the IRS has slowly put contractions on what you can do and how much is even allowed, but you're still seeing a lot of people confused or just out and out abusing this. So
Abusing it. Actually, again, it's about the documentation. I just yesterday completed an audit, and that was one of the areas that the auditor was looking at in depth, because there's such strict substantiation requirements for meals and entertainment, that they're looking everywhere for it, because it could be buried anywhere, right? I think taxpayers bury it in all kinds of other places, but they're looking for it. So they're going to look for personal meals that, as opposed to business. They're going to look for, the documentation of those expenses. So make sure that the amount, the place, the person, the nature of the business, as long as you have documentation for all that, it really supports your case. And I always remember that it's only still 50% deductible.
Yes.
You don't get a full deduction. It's only 50% deductible when you're out with a client or a customer or providing meals for marketing purposes in any way in promotion. Those those costs are 50%
So
deductible.
Michelle, for those people who are still work in the paper world and don't have electronic ways to do that, would you say the simplest advice to give to them would be after they sign the credit card receipt or whatever it is on the back of the bill, to just write the client's name down and whatever the topic of conversation was, and then throw it in their shoebox to bring to you?
Absolutely, because a credit card statement is not sufficient documentation. You'd have to have the receipt to support that credit card charge, along with the whole write-up of, what
Now,
happened.
just so now we're running out of time, but I wanted to say, in the news these days are about politicians going to big conferences and events, getting $500,000 speaking fees for doing so, and the company writing that off. Now, is that an entertainment expense? How are they able,
they're
are
taking
these
it as-
extravagant affairs that they
Yes, well, the extravagancy could be questioned, but it depends on the circumstances. So if they're gonna fly somebody in from Australia for a speaking engagement, first-class fare might be reasonable because they're
So long,
flying for
sure.
18 hours.
Yeah.
But if you're going from, San Francisco to LA, first class probably isn't gonna pass muster. It has to be reasonable and necessary and, ordinary and necessary for your business and a reasonable.
So how can they justify paying any human being, no matter how unbelievably bright they may be,
$500,000
for an hour-long speech? I mean, yeah.
It's an interesting.
But I digress, I think, perhaps. All right, that's enough for now.
I don't know, yeah.
Well, thank you so much for being here and
Thank you for the
participating
opportunity. I
with
appreciate
us.
it both.
And if anyone is looking for, forgive the plug, but I can't help myself, looking for great tax advice, Michelle and the people at Eckhoff, we'd love working with you guys. So,
And likewise, love working with you.
Kate, could you please wrap us up?
Yeah, so thank you, everybody, for joining us for our first quarter forecast 2016 webinar. Thanks again, Michelle, for coming. It's great having you here, and Andy and Bruce for entertaining us all for the last hour. And this concludes our meeting.
May I interrupt you?
Yeah.
We just have a minute left. So there is a question here.
Okay.
Michelle, can you see Tim's question?
Yeah, good question.
So you want to read it for?
Okay, oh yeah, we should read for everyone, thank you. So with regard to meals and entertainment, Tim is asking, and their deductions, does it make sense to file these even when the business is not making any money? So for example, in a startup situation.
I'll give you the answer that I love to give. It depends. It depends. What else is going on? Would those expenses be able to be, deducted in some other way? Is there other income that can offset the loss? So we have to look at the bigger picture.
Okay. So, all right, Tim, so you got the classic, it depends. So, but I'll let Michelle follow up with you.
Yes.
And we'll go from there. But thank you, everyone. Thanks, Kay, Andy, Michelle, and thank you all for participating. If you need any help, feel free to call the office at 415-334-8000, and we'll be happy to talk to you.
Yeah, thanks. And if anybody needs to get a message to Michelle as well, just go ahead and run it through us, and we'll make sure that she gets it and gets, connected with you.
Everyone have a wonderful rest of your day and a great weekend. Bye-bye.
Thank you.
Thank you.
Thank you.